This is Macro Horizons, episode 363, Madness of March, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of March 2nd. As February comes to an end, attention has intuitively shifted to the spring equinox, the change in seasons, not the gym. Although we'd probably benefit more from seeing the latter as well. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market was reasonably well bid, with three-handle 10s being very topical, as the 10-year sector consolidated between a 4.0 and 4.1% range. To some extent, this was attributed to wobbles in the equity market, where we saw pressure on some of the key tech names. Now, while this certainly hasn't brought equities onto the radar for monetary policymakers in terms of the potential for tightening financial conditions per se, it has nonetheless reflected an investor base that is looking for the next narrative, particularly in U.S. rates. From a medium-term perspective, we took solace in the fact that treasuries as an asset class have continued to demonstrate that they've retained their status as a flight to quality asset. Recall that throughout much of 2025, and arguably at the beginning of 2026, there had been a trend of selling or buying U.S. assets. So we'd see both treasuries cheapen while equities cheapen at the same time. Now we're back to the more risk-on, risk-off dynamic where treasuries rally when stocks sell off and vice versa. The degree to which this will define the relationship between equities and treasuries remains to be seen, but for the time being, this is clearly the correlation of note. On the data front, we also saw initial jobless claims come in below expectations at 212,000, which, while higher than the prior week's print, is still low in outright terms, and overall is still consistent with the notion that the labor market has stabilized in recent months. The trajectory of the labor market over the next few months will be very much in focus, particularly given the fact that the Fed seems willing to move forward with the stabilization narrative, and the market, to a large extent, has taken that at face value. While immigration reform has clearly weighed on what the market believes is the break-even rate for headline payrolls growth, there is still sufficient uncertainty regarding whether or not the unemployment rate can remain below 4.5% for the balance of the year, which seems to be the Fed's assumption at the moment. We also heard from Bowman, who once again focused on bank deregulation as a way of reducing the Fed's balance sheet. While it's challenging to assume that this will be a short-term deliverable by the Fed, the conversations about deregulation should continue to provide backing for cash outperformance versus swaps, at least on a relative basis, and table some concerns about the Treasury Department's need to eventually increase coupon auction sizes.
While there wasn't a great deal of excitement this week in the Treasury market, we did get a fairly soft 5-year auction that tailed nearly a full basis point, but given the price action around the auction itself, it was hardly a watershed moment for the overall trajectory of the market, and similarly with limited economic data, probably this week's highlight being PPI, The biggest takeaway from this week was that 10-year yields have once again found themselves in a new range, this time a lower one between 4 and 4.10, as investors continue to debate the performance of risk assets, the potentially disinflationary implications of AI, and the latest performance of the labor market, as we prepare for next week's jobs print and the quickly approaching March FOMC, as spring gets underway with 10-year yields far closer to a 3-handle than a 5-handle.
And it is notable that we effectively traded a range of 410 to 420 for a range of 4% to 4.10. That 10 basis point range shifting lower reflects the cross currents of sentiment in the Treasury market. On the one hand, there are open questions regarding the performance of the labor market and the forward outlook for jobs. On the other hand, the final mile to get inflation back to the Fed's objective has proven to be challenging. Now, to some extent, one could argue that this was to be anticipated, certainly consistent with the guidance from monetary policymakers, but nonetheless, this has resulted with the U.S. rates market being largely range-bound, with the looming potential for three-handle tens. It's also worth observing that the Bollinger Bands, which is plus or minus 2 standard deviations around the 20-day moving average, have widened out significantly over the course of the last 3 weeks. Perhaps more importantly, this is the first time the lower Bollinger Band, which currently stands at 396, has moved below 4% since the middle of December. Said differently, there's less and less technical resistance to break below 4%. We also took a reasonable amount of encouragement from the fact, as you point out, Ben, there wasn't a particularly adverse reaction to the 0.8 of a basis point tail in the 5-year auction, a result that was also accompanied by the largest dealer allocation since March 2025. If such a result had immediately followed last year's ratcheting up of trade tensions, then it wouldn't have been surprising to see the narrative shift back to concerns for treasuries as an asset class. Fast forward to today, and investors appear to have moved well beyond concerns with treasuries as an asset class and the potential for a buyer's strike.
And that's been consistent with flows that we've seen and heard of as well. Specifically, that after a large part of 2025 was spent pondering the investability of treasuries and whether the combination of the fiscal situation, tariff policies, inflationary concerns would all mean that there would be no buyers of treasuries, specifically the long end of the curve. More recently, in both treasury and MBS space, what we've seen is a positioning away from what was a material underweight the long end of the curve and a collective expectation for higher yields, and toward a more conservative attitude around risk asset valuations and around the idea that it's inevitable the curve is going to bear steepened and 30-year yields simply have to be well above 5%. This price action has been reflected in the shape of the curve as well, with 2s10s flattening back below 60 basis points. And as an explanation for the bull flattening price action, we're increasingly of the opinion that if we have a wash Fed and cutting to 3% more or less price, then the overall shape of the curve is going to increasingly be a function of how the long end performs in outright terms. It's obviously going to be challenging to see a material sell-off in the very front end, given the fact that the Fed is still cutting, despite what we're seeing in terms of a relatively resilient labor market. And on the flip side, the powers that be in Washington continue to want to see lower 10-year yields, both for mortgage rates and also stimulating overall economic activity and credit expansion. And so while there is still room for the curve to steepen, we're left to consider just how far away we are from this cycle's steep prints, given the combination of the Fed driving the front end and the tone shift we've heard as it relates to issuance in the back end and what that means for the bear steepening trade.
It is notable that a wash Fed and his views on the balance sheet, i.e. smaller, not larger, were generally consistent with the curve steepening trade as well. The fact that the conversation has shifted to the regulatory side as a way of reducing the Fed's balance sheet over time suggests that the Fed's balance sheet itself is no longer a driving factor underlying a steepening bias, at least for the time being. Moreover, we're reminded that typically the more dramatic curve steepening moves don't occur in bond bearish fashion, certainly not in outright terms, but rather are driven by a repricing towards lower monetary policy rate expectations going forward, i.e. a bull steepening led by the 2-year sector. While 2-year yields have drifted a bit lower recently, the more relevant moves have been further out the curve, with 10-year yields approaching a 3-handle and 5-handle long bonds now a distant memory.
And away from the Fed and Treasury issuance, let us not forget the simmering tensions in the Middle East and what continues to be a growing military buildup in the Persian Gulf, as there's a collective sense that something is going to happen in Iran in the not-too-distant future. Now, what ultimately transpires in the region is certainly outside of any intellectual insight we can offer. However, to look at the price action in oil, and frankly what we've seen in the Treasury market as well, there's some probability of a more material escalation priced in, and the fact that diplomatic avenues continue to muddle along with the continued shift of U.S. military assets into the region, leave us marginally more concerned around the potential for a more dramatic escalation in the near to medium term. In fact, the argument can be made that that's part of the reason that we've seen 10s trading closer to 4% than 4.25, as the potential inflationary implications from the risk of higher oil prices has, at least for the moment, been outweighed by the flight to quality appeal of 10s. Now, how long this ultimately persists, and the scale of any repricing in commodities, risk assets, and treasuries will obviously be a function of what ultimately plays out over the next few weeks. But away from the domestic data and monetary policy, this certainly will continue to be a space to watch as March gets underway.
And in a more typical environment, one might expect flight to quality associated with armed conflict to be the biggest takeaway. However, if we look at the way that some of the recent conflicts have been traded, in the Treasury market at least, they have been viewed through the lens of their inflationary implications. Very consistent with your observations, Ben, regarding the commodity market. This dynamic has made it at least marginally more difficult to push rates lower, and if anything, should reinforce the curve steepening move. However, as we have seen, the overall bid for duration has surprisingly defined the curve and left the recent peaks, particularly in 2s, 10s, well above current levels.
And while equities are not currently at all-time highs, the fact that the S&P 500 remains within just a few percentage points of its peaks indicates one of two things. Either investors are not all that concerned about what's going on the geopolitical front, or even if those risks do ultimately come to pass in the form of a more significant escalation, that the resulting increase in oil prices or general instability of the region is not all that much of a game changer for domestic equity valuations. And frankly, given the dominance of the AI discussion in terms of what's driving broader risk sentiment at the moment, we're sympathetic to this idea, because whether or not there is a deal struck between DC and Tehran is probably not going to be all that impactful for AI valuations and, in turn, the overall level of the stock market.
Like they say, robots don't go shopping at the mall, but they sure demand a lot of energy. In the week ahead, the marquee data release will be Friday's February non-farm payrolls figures, which are seen increasing a solid 60,000 jobs during the month. The unemployment rate is anticipated to uptick 0.1% to 4.4%, and average hourly earnings are seen at 0.3%. The week ahead will also see ISM manufacturing, as well as ISM services, which both include an employment component. Let us not forget, we have Wednesday's ADP report, and here the market is anticipating a solid, certainly by recent standards, increase of 43,000 jobs. It will be notable to see if there is a divergence between the private data, ADP, Challenger, etc., and the official marquee payrolls report. That was the case for the January series, and what we saw in January, with the stronger than expected headline number, was that the market was willing to push yields higher in the wake of the data. However, that dip was quickly bought. Another wild card on the horizon is the January retail sales report, which is released alongside non-farm payrolls at 8:30 on Friday morning. Now, while we're tempted to suggest that typically payrolls would be weighted more heavily in terms of the response in the U.S. rates market, the reality is that the surprise in the December data and the subsequent market reaction was the disappointing retail sales figures, which were 0.0 for the month of December. When we couple this with the information that was revealed via the Q4 GDP number and the deceleration of growth in real personal spending, it all implies that the consumer might not be on the strongest footing as 2026 gets underway. The consumption side of the real GDP equation has only recently become an open question, and while generally it is assumed that as long as equities are at or near record prices, the top 10% of households that account for roughly 50% of consumption in the U.S. will continue to, on net, drive growth. Now, this doesn't mean that there won't be certain subsets of the U.S. consumer base that are suffering from higher prices or pockets of deteriorating employment prospects. But on aggregate, as long as equity valuations continue to drift higher, the market seems content with the notion that consumption will follow suit, until it doesn't. We're concerned that what we saw in retail sales and real personal spending in the month of December is just the beginning of a more durable pullback as a result of the fresh set of uncertainties associated with the more modest outlook for the labor market. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. With spring just around the corner, and New Year's resolutions fully abandoned, all that we have to say is, Dear Kale, thanks for the memories. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.